Welcome to the podcast on video, of course. It's the Christmas edition of the Paul Hill show. He's got his red tie on. But the question is, Paul, will Santa turn up this year? We've been here for 18 months in this dreary market. Is Santa, Santa rally is last 5 days a year, isn't it? So we should be there.
I don't think we're going to get a Santa rally, but I have actually got Santa's tie on, as you noticed.
Yeah,
so,
I can see that. It's nice. But I think Santa's been affected by, high fuel prices. That sleigh costs a lot of money to run.
Well, it's quite interesting actually, because you raise probably the most important sort of like catalyst for next year, because we've obviously talked about what could actually go right next year in terms of the end of the war in Ukraine, which would be a massive sort of like fillip to the market, and likewise if we get a good positive reopening in China without stoking inflation, that would be hugely. But I actually think sentiment, consumers and businesses have been held back most by this, the energy crisis, which is obviously, with the cost of living, etc. And if we start seeing that roll over, people will start putting the heating on, people will start feeling more positive, will go out more, and businesses and sentiment will start spending. Because if you think about it, I don't know about you, I know you do a poll of my sort of road and stuff, but most people can afford to keep the heating on, and most people can afford to go out. But actually, because of the sticker price shock and just because of what we're going through, there's this sort of like fallow period, which is just knocking GDP. But once we get over that, that could actually just be sentiment-wise a huge positive for the market.
Yeah, and there is, it's a behavior changes. It's feared by media a lot, isn't it? Because we've been sucked into it. Like I said, we've been very stingy on our heating, and we can sort of afford it. But you do get sucked into it, and if you extrapolate that over millions of people, of course it knocks the economy. But and all we have at the moment is fear. There's no good news. Everything's priced into the market fear-wise. What else is there? We know all the bad news. Where's the good news? What if inflation drops faster than we think? That's not priced in. Companies often find efficiencies in these times, and many big successful companies have been formed in recession. So there's lots of positive stuff. And also the weaker market players so get taken out. And that's the bad thing, but that means the good companies, the strong companies, become even better, faster growing. And so there's no good news priced in. It's all bad, dreary news. And I'm sort of sucked into it as well. I'm got a bit of cash in the portfolio, but I just want to see the change in direction of the market. It's been 18 months of hard work, and I'm thinking, God, it's almost swimming against the tide. And so now I'm waiting for some kind of catalyst. I just think it get to the stage where, like you say, I think we'll have, get used to the bad news. We won't have to put the heating on so much in the next year, but I think prices have come down. In fact, if you look at things like, oil and gas, they're all down, all commodities are down. That will take a while to play into, all stuff on the shelves and all that stuff and all that, but it will happen. And what we're going to worry about, though, is we don't spend too much and inflation goes back up. So yeah, I know. So
but I think that'll be a major boost. And the other one, which has obviously dragged a lot of small businesses in the UK down, things like Fulham Shore, who own Franca, is the rail strikes. Just being able to get access into town centres, and they've basically had a bit of a profit warning in December, saying that the footfall into restaurants, particularly at lunchtime for business people, is just not there because of the people not being able to get into the town centres. So again, it's a combination of everything, I believe, and I'm hoping by sort of in 12 months' time there'll be a lot better perspective. But I would say most of the big sort of strategists from the investment banks who have been putting out their scaremongering, they're saying, and the consensus seems to be, we're going to get a bit of a bloodbath in the first quarter or second quarter of next year, and we're going to retest the low, certainly on the S&P 500. And I mean, I did a capital markets summit with some real big industry hitters. Martin Gilbert, who's the founder and the starter of Aberdeen Asset Management, Chris Watling, who's absolutely brilliant, and James Athey, again, he's from Aberdeen, he's a bond king. And their consensus view, actually the S&P, and it's currently trading at 4,000, roughly round about sort of like, I think it's about 17 times forward peak. They reckon the S&P could hit below 3,000 at the start, towards the beginning of next year. So all I would say is that the market is setting itself up for a bit of sort of like, volatility, and then hopefully will rebound later in the year when the Fed eventually pivots, as the market's suggesting in the bond market. But there's two things I would say. First of all, consensus rarely comes right in terms of where it's going to be. But if it is right this year, and that's where the smart money is, also we say for next year, just hold on and don't get blown out by everybody else. You can try and be too cute, trying to time the market that it's going to be a swan dive in the first sort of 3 to 4 months, and then we're going to all go buy in. But I would say having sort of a bit of spare cash on the sidelines isn't a stupid strategy heading into that potential downturn. So I mean, I don't know what you're doing.
Yeah, no, I've got I've got cash. I've just lightened up. I mean, one of the companies I sold it raised a bit of cash. There was K3 Capital.
Yeah, well done, big congrats. Pat on the back.
I know. Do you know what? I think this month, for the first time for quite a few months, my portfolio value has gone up.
Happy Christmas.
K3 Capital I sold because the offer was 350, and one of the members of my club said, "How long will it take if they get taken over before you get the cash back?" I thought, do you know what? That's a fair point. I don't want to be sitting there with my cash tied up in that for a couple of months or whatever, when it could be allocated elsewhere or just be in cash. So I thought it was at 342. I sold, and I've got that in cash. But do you know what? Very interesting. I was looking at the S&P charts. Very interesting. Just that 200-day moving average. Now listen to this for a stat. On the 20th of April, right, it attempted to break up above the 200-day moving average. It failed. 57 days later, it dropped by 18%. It tried to do it again on the 16th of October. It failed. 57 days later, it tried it again. So it's two sets of 50 days, and that it dropped by 17%. Now, so first time 18%, second time 17%. Now it's just failed again on the 30th of November. And if it takes another 57 days again, and drops like 17%, that would be 3,300 on the 26th of the 1st. So and it's really playing out. You see, it's failing all the time, and it's in a downtrend.
So the 26th of January is going to be about a month's time. Is it 4 or 5 weeks?
Yeah, exactly. I think they'll run about. It's almost like a great financial crash. Around March or something like that, I think we'll start to see a rally. New money coming in April, because apart from December, the last 5 days, apparently April around about that time is one of those bullish times of the market. I think if anything, it could we could be bumping, trying to find the bottom before that time, but I think we may start to see a rally in that just after the first quarter. I think.
You're right. I mean, I'm not a technical boy. I mean, obviously, you know a lot more about it, but actually, that is quite sort of like well-trodden ground. It's the Fibonacci retracement, isn't it? It's sort of like he tries to hit the 200-day, and then similar sort of time zones fails and falls down. And I think that's partly supporting what the consensus fundamental view is, that what will happen in Q1 is that actually Christmas is going to be a bit of a damp squib. There's still going to be a lot of inventory to sell through, and that's going to sort of like drag on a lot of GDP. Energy is still going to stay quite high in that period, and the Fed's going to keep hitting the interest rate nail on the head, regardless of what the the economy is doing. And on that basis, people are sort of baking into this, because there's a bit of a strange anomaly to a certain extent, but we are in a bit of a Christmas theme, isn't it? So it's like cooking a turkey, the economy, with central banks, because essentially you have to take your turkey out the oven about 15 minutes before it's perfect, just let it sort of rest and stuff. Now, the market is worried that the Federal Reserve is going to cook the economy and leave it in the oven far too long. And so when it actually takes it out, it's going to be dry and crisp and sort of charcoal.
Well, that's going to be the title of this podcast anyway. Is the Fed overcooking the turkey?
Yeah,
I think they definitely are. Yeah, but do you know what? Just going back to that S&P stat, if it does do that, right, then it's around about very close to the average without recession bear market for the S&P, and that's the average drop, which is about 3,400. Average with sort of average with recession is down to 2,782. So that's and if you look at even AIM, the AIM market, it may have another falling out, but it hit a low, back in August, and it's rallied, and it hasn't retested that low yet. And we're now 470 days from the high. That's quite a long time, and that's beyond sort of within average time of so. Will this be longer than the average? I think inflation is a hard thing to bring down, and even if it does drop off a cliff, it may, it doesn't go straight down, does it? It may rally again, like we've seen previously. So, there may be I don't think it's a straight recovery going to happen. I think there will be some volatility even next year, but I think we may have seen the bottom by Q1. Hopefully, who knows? But who knows?
Yeah, well, I say that's what the market is. I would highlight to investors, if I was going to take one data point that people should really sort of like, focus in on, look at what the S&P analysts are saying for 2024 earnings expectations and see how that starts developing in Q1. So not next year, because everybody reckons it's going to be a bit of a bath, and they're not sure whether it's going to be $200 per share or 220 or 200, even 230. But let's just assume there is going to be volatility. And, you know, even the worst scenario, it's going to go, you know, it's $200 per share. You put a 16 times multiple, you get to your 3,200 compared to 4,000. But it's really what's going to drive earnings afterwards in 2024. And if we do start seeing the Fed roll over, then that earnings expectations is going to stay reasonably, you know, okay. And it seems to be consensus is around about 240 to 250. Again, you stick a sort of 16 times multiple on 240, 250, and you get sort of like, you know, round about sort of 4,000, just over 4,000. So that's going to be the real anchor, and the driver is what the corporate profits are doing next year. And we shouldn't get, balance sheets are in a reasonable shape. Hopefully we won't get too many defaults. And if we can get through that, then all we're talking about is a contraction in operating margins, and hopefully expand in 2024. But the other side of that coin is that if you do get a harder landing, you will start getting defaults. You'll also get, you know, counterparty risk, which was something that was scaring everybody in the great financial crisis. And then we've seen it again, you know, what you're getting at the moment. You are starting to see a pickup in delistings in small caps and stuff, because they're not getting any liquidity and any interest at all on the markets, and just saying, well, I might as well take my money off and, you know, paying the bills or being a listed company, and they're bought by management or whatever.
Yeah, there's a few delistings or takeovers. Yes, it's happening. Do you know what? I saw an analyst yesterday on CNBC. I can't remember her name, but I think she was saying during a recession, the average drawdown in earnings per share between 20 and 30% for American companies. And so at the moment, all the brokers are pricing in is 5%. So
an increase as well. If you look at
some of them,
they've got the current consensus for this year is 220 for 2022. They've actually, for bottom-up analysts, they're saying 230 still, but then the top-down analysts are probably hitting around about flat to 220 to 210. So there's a difference between your bottom-up and your top-down analysts.
Yeah. And the thing is, how this plays in the market as well is that people, like me myself now, I've got a bit of a cash there, and people sell into any rally that happens, they sell into. So no lift is sustainable, and you get this grinding lower and lower. And where does it stop? Who knows? And that's the thing with trends, isn't it? When you see a downtrend, don't fight it, because you are against the market. You're against the sellers. Wait until people start coming back into the market, and then you can't surf with no swell. You've got to have a wave to surf on. So there's no point when you're bored in now yet, before the market's going in the right direction. But
you should change the title for this thing. You should have Sam to go surfing.
Exactly.
But there's actually a really good strategist on Wall Street who's called it perfectly this year. A guy called Mike Wilson, who's the head of sort of like all things investing out for Morgan Stanley, and he reckons there's going to be the earnings per share for the S&P 500 is going down to 195 for 2023, but then rebound to 241 the following year, and he reckons that's consensus about 250. So again, I mean, all chips are once you go out to that sort of level, it's difficult to say what all the moving parts are. But I still see there's a lots of positive catalysts that could make a massive difference to sort of sentiment in particular is how the economy is. So.
Do you know what? The reason why I'm have cash, by the way, is because one of the best times ever to make money, and I did in the last great financial crash, and the best times ever, I went big on Lloyd's Bank. It was a bit of a risky play.
Black horse.
I pretty much put all my money into it, and thinking surely they're not going to go bankrupt. Biggest mortgage holder, quite a safe bank, a bit of the rest of us at the time before they bought. And I thought the big worry was the Bank of England going to buy them up or take them over, and that was the worry. It didn't happen. I did well there, but looking this, and this is, do you know what I've been looking at recently, doing a bit of research on, is Housebuilders. And I've got lots of cash there. Now is not the time yet, because they're in a downtrend. But if you look what happened in the great financial crash, it was a financial crash. The banks were largely affected more than any other sector. Of course, there's contagion. Right now, of course, you've got inflation. Interest rates are going up. You've had house builders showing that cancellations are up by 10, 15%. But the big boys, they're well capitalized. A lot of them got no debt, operating margins at 20% plus. They're paying excellent dividends, doing share buybacks. That may stop. But I mean, at the moment, they're like, some of them at Persimmon, for example, by 50% they've fallen by. Okay, they're not going to start making a loss, surely. They're still going to be generating cash. So even if you be really conservative, I mean, they're all in downtrends at the moment. There's no point sort of jumping in early, and dividends are, I think next quarter they start paying dividends in the interim. But I mean, in my mind, they are not as bad as the banks in the great financial crash, but they are at the moment being, massively hit. And they're good businesses, very good, well-proven businesses, good margins, very efficient. And let's be honest, housing in the UK is never going to go out of favor for long. You don't see house prices taking a dip for years on end. It doesn't happen. So people always want to buy a home. So I think keep an eye on the house builders. Not yet.
Yeah,
not yet.
I mean, I think you raise a great point, because actually, what the recession is really rolling across different sectors, because there's a recession in housing that has been in the States for 6 months already, and is starting to hit the UK. But it's identifying those sectors which go into the recession first, but come out first, and that's what will happen with the house builders. And I'm with you. I think they're pretty attractively valued. I mean, I'm not sure what Persimmon is, but I bet it's about sort of like 20% discount to its net tangible assets. I know Taylor Wimp is on about that sort of level. Probably Barratt is a similar sort of. But you're right, they've got a lot of cash, and they're very well, they've got good sort of like pipelines and all this sort of stuff. So yes, it might take a sort of a slow air pocket in demand, but they can withstand it, and it's just a matter of time before we come through, and they'll be the first to benefit. And so, holding some cash for the sectors that are actually going to come out the recession fastest, if we do go into recession, and it looks as though we're almost certainly there, makes perfect sense. What's your cash holding so far? Well, currently
about 47%.
Wow, 47.
Yeah. I just, and this is my reasoning is. When I first started off, I sort of investing properly, which is just before the great financial crash. I didn't know what I was doing, and then in the end, I was looking around to try. I had lots of different stocks. And I thought I sold a lot pretty much. And I thought, right, do you know what? I'm going to go big on Lloyd's, and it sort of paid off. But I mean, I had a wake up in the middle of the night moment a couple of times, thinking, "Oh my God, it's going through." Yeah. But I did really well on it, and I was thinking now that the banks were in a bit of trouble back then, but the house builders aren't in trouble. Like I said, if you look at Persimmon, for example, very little debt. I mean, in fact, Redrow, Persimmon, in fact, smaller MG Gleeson, no debt whatsoever. These companies are paying 9% dividends. Barratt's doing a buyback, Redrow's doing a buyback. I think give it a bit of time, and while you wait, once you sort of confront all the worries out there, you can earn a dividend, nice dividend, and they will rally. They, like Barratt, 1.1 billion net cash. It's like they're on like.
And the other really good point you make there on a broader perspective is not only looking for those sectors which are beaten down and going to come out first, but also you're actually upskilling, you're upgrading the quality of your portfolio rather than the micro caps. You're actually going to big cap, sort of like tried and trusted business models that have long-term secular.
You read my mind.
Well, there you go. I think you're doing perfectly. I think you're doing exactly the right thing.
Doing a webinar tonight, I'm reading about that. Somebody asked me why I'd sold micro caps, and I said, listen, I mean, the reason why I'm in micro caps is for high reward, but they're also high risk. And in this environment, we're in a bear market where capital is very expensive, and they're not yet, operationally profitable in any way, and they may have to go back to the market. It's unforgiving. Now, what you can do is get a good reward from, like I said, tried and tested, very good businesses. Now, the microcaps, I'm hoping will be very good businesses. These are very good businesses. They just take a little downturn, and you can sort of, okay, you may not get sort of, 300% or whatever that like a microcap can give you, but you can get a couple of 100% probably with dividends and everything over the next few years. So,
I would agree. So, yeah.
And that's in a, less risky. So the risk reward there is a lot better profile than in microcaps. And so
they call that the Sharpe ratio. I've actually got now a big chunk of cash coming in myself, because you've obviously benefited from K3 Capital. But
load.
Crestchic. Yeah, I mean, they've basically had a an agreed offer, probably people know, by Agrico, who are effectively one of their customers, because Agrico buy load banks from Crestchic, from many other suppliers. Anyway, they want to vertically integrate, and therefore there shouldn't be any competition concerns in this, because vertical integration is absolutely fine usually. But they've put a price of 401. It's funny that some of the parts was, or not some of the parts, my fair value was £4. But looking sort of like, that's on a standalone basis. So it's a good, decent price, and I'm happy to take it, really not a problem. But what's been quite interesting is that actually you've got some of the hedge funds now have gone in, and there's one of them who went in from the Cayman Islands, bought about 6%, just under, last couple of days. And so they think there's going to be a potential opportunity to make more money, because there'll be other people who will be interested in the sort of interested parties could be Ashted, because they run a plant in the UK, and Schneider Electric as well, so they're possible. But I would say Agrico are probably the game in town, because they can generate the most amount of synergies, and that will probably deter any other potential buyers. But yeah, I'll be in a similar sort of, I won't be quite as heavy on the cash, but if I get that that cash in sort of like late Feb, for instance, early March, then I'll be hitting it around about 40%, just over. So I'm looking to you. I'm going to follow your strategy. Go into sectors that are beaten down, are probably likely to come up, are solid, got lots of cash, paying dividends. You're going to be able to sleep at night, and you're upskilling. Importantly, you're upskilling or upgrading the quality of your portfolio. So I think it's a seminal moment, actually, for people like like me and you.
Yeah, no, absolutely. I just looking back at the great financial crash, looking at the Housebuilders, and it took a while. I mean, they sort of flatlined for quite a few months after things started recovering, but then they really started moving, and people started catching on. And like I said, at the end of the day, it's about owning a share of a business. Now, what do you want to own a share of? A very good business that's proven, or a riskier one with the hope of it, improving. So, I said these are. I was amazed actually how all of them, or the top five, have got very little debt. All very, operationally sort of efficient. And like I said, let's be honest, the UK house market is going to cool off a little bit, but over the next 5-10 years, it's going to carry on going up. Pretty much.
Yeah, but as long as you've got a reasonably long time horizons, you're fine. I mean, there's one company that I'll be,
But anyway, that's a point. And those kind of companies you can hold for years and years, and they're paying you dividends, and it's nice. Yeah. So yeah.
As long as you've got the patience there, Justin.
Yeah. I've held most of my, in fact, apart from recently, I've held most of my stock for years. But I mean, and in fact, I've held them too long, and I should realize, just paying attention to crossovers on the moving average. I should have got out when the trend started down, and I didn't. That's the thing. I got too greedy on the way up, made a good money, and then give some of it back to the market, which is silly, really.
Yeah. But one company is on my shopping list, because it's an industrial, which would swap out with Crestchic, which I haven't bought, but certainly might buy in the beginning of sort of like next year, or after I get some funds in. Is Avingtrans, and they came out with a statement. They're basically massively into all things nuclear. They do these, what they call security boxes, safety storage boxes at Sellafield. They do blast-proof doors for HS2. So they've got some really strong niche positions. They've got excellent management team, and they do this sort of like pie strategy, which is pinpoint, invest, exit strategy. And they've just put £2 million into their healthcare, their medical division, into one of the companies that they've previously invested in, Adaptix. It's a convertible bond. And what that says to me is that, basically they're using this opportunity again to increase their stake in leading edge technology. They've got a really fabulous industrial type of business, but they want to move into healthcare. And I spoke to Christopher Mills, who's a big shareholder of these, and he loves it. So I think this is a great sum of the parts story. Sort of bare minimum, I reckon it's £5.60 per share. Current shares are about over £4, so there isn't that much upside at the moment. But I would say that this is a high quality, long-term, sort of like compounding business that has share prices has gone up by 20% per annum over the last sort of 15 years. I mean, the management team is absolutely top notch. So this is a kind of quality player that I would certainly, sort of consider putting some money into when I get some cash in.
Yeah, look at that. When we look back at these big sell-offs, I mean, that was I hit £2 on the dash for cash crash, and now it's 4.39.
Yeah. And another two, and it's unfortunate I already own the shares, and I know you own one who came out with really good trading updates. In fact, they've increased their expectations. First of all, is Argentex, who you own and I own, but we don't own enough. We'd like to own some more.
Yeah.
And they've increased their expectations for the year. They've changed their year end from March to December, so they'll come out with another trading update in January. But they're trading at about 8.5 times EBITDA at current levels, so they're cheap. The sector's on about 17, and they're growing their top line at sort of like 40% per annum, and it's absolutely fabulous. And they've got this really great strategy whereby they're going to put on overseas expansion to their real sweet spot into SME markets. They do all things sort of foreign exchange and international payments in the UK as a tailored service for corporates largely, and for also some of the fund managers and stuff like that. But they've got the overseas expansion out into Holland, as you know, and into Australia. Plus they're overlaying the technology platform on top, and that will just be pure sort of like great scalable technology, just to add extra revenues and profits to their existing client base. So that's all really jam coming, and that makes perfect sense, because as I say, it's a much better service then for your clients, and you make more money. I mean, it's a total win-win scenario, and I could see these guys doubling their profits over the next 2 or 3 years, no problems at all, and they're already cheap. So again, a high quality business that's knocking the ball out of the park, and there was no reason to sell this one. If anything, you'd be picking more shares up. I don't know what you're doing, Justin. Are you going to sort of like think about Argentex now?
Yeah, no, do you know what? I really like Argentex. When I'm looking around for companies, and sometimes you look in your portfolio and think, that's still a very good company. I haven't got full exposure to that. And they're growing very quickly. Their margins are very good. They're very efficient. They can scale very quickly. And I like them a lot, you know. And
you and I have got to sort of like sort of compare notes and look for these type of beautiful sort of like gems. And another one in that sector which has really outperformed, I know we've talked about, is EQLS, and they upgraded expectations as well. They're growing at even faster than 40%. They're going at 60% per annum up at the end of November. And you'll see some real operating leverage coming through the business next year as well, as some of the investments they've made. And the one thing I really do like, which I just don't think the market's really appreciated yet, is that they bought this really small business called Rocket, which does all things payments on the inbound. So they do all outbound international payments for corporates, etc. in the UK. So that's into dollars, into euros, and to all kinds of different currencies. But they're more of a platform than actually Argentex is, with the systems wise. But adding this inbound element, so all their existing clients, they'll be able to say to them, we'll be like, let's just say, for instance, they've got, I don't know, a retailer who's buying from abroad and therefore using them already to buy, to buy goods from overseas and the forex side of it. But say to a UK retailer, they could say to them, well, if you're selling abroad or selling in the UK, we can now do all your, your payments in coming in from your customers as well. And I mean, that's just what a fabulous model that is. And I think they'll really leverage that. I think that could just be a total home run over the next 2 years. So yeah, I'm really positive on both of those businesses, both in a really big sweet spot. They've got, inflation resistance there, and they're taking market share hand over fist. So I've got a large chunk, so I can't add any more. I've been, as you know, I'm fully loaded on it. But
do you know what?
Not a perfect area.
They've had a fantastic, excellent run. They from like 2021, where they're at 28 pence.
Yeah.
And now at 86 pence. But do you know what? When they were shooting up, they very rarely touched the 200-day moving average. When they did, it was a buying opportunity. They've just touched it quite a few times recently. Now, previously, that's been a buying. I mean, obviously, they could go below it. But I mean, if you look back in the last year or so, whenever they've done that, they just rallied off it. And so, maybe worth a look. Everyone, I had an alert actually today. I think it touched the 200-day moving in the average. So,
it's buying. I mean, if you haven't got any shares, 85p is a buying opportunity, because they're trading at about sort of like less than 11 times EBITDA, sectors at 17, but these guys are absolutely flying. I mean, we're talking 50-60% per annum growth last year. They won't do that next year, probably. I mean, I'd love to think they will, but the market's certainly not saying that. I mean, if they good double digits on a sort of like higher operating leverage, that will make a massive difference in terms of the profits. And they've got a really solid balance sheet, plenty of cash, both them and Argentex, in fact. So there's very little downside risk. I mean, there's always is risk, you never know, but let's be clear about it. Anyway, that's what I'm holding. There's no doubt about it.
Yeah. I'm still holding microcaps. So I think they'll rally strongly. I just think, like I said, a chance upgrade as well to businesses. Do you know what? It's amazing. I don't know if I said this if you talked about this a couple of weeks back, but everyone's talking about the cost of living squeeze and no one's spending. So a couple of weeks back, me and mates went out. Every Christmas we go out somewhere, and we decided to go to Boom Battle Bar in
Oxford. In Southampton. Okay.
In Southampton, yeah. And I literally. First of all, West Quay, the shopping area, was very busy in Southampton. The ice rink was there, very busy. We went into Boom Battle about 1:30. It was like 30% full. I thought it's not bad for 1:30 on a Saturday. But 3:00, it was jam-packed.
Wow.
Literally 5:30, it was rammed. 5:30 in the Saturday afternoon. I thought, mostly we were the oldest people there. It's like we were, I'm 50 and my two mates in the 40s, but we were leaving, and most people in their 20s. And I don't think they have the same cost of living worries that everyone else has. It's like the demographic they're targeting. So I know, there may be worries about that, but I think they're very well targeted, and it's a bit different. We went to All Bar One next door, and it was full, but people just paying for drinks there. In Boom Battle Bar, you can have drinks and you pay for games as well. So you're paying doubly.
I'll give you another data point to help you on that one in the XP factory. When I interviewed Harry Adams, the CEO at Argentex, his office overlooks Oxford Circus, which is where Boom Battle Bars is, and he says he's never seen it, Oxford Circus, so busy. And he's been there for like 10 to 15 years with his office overlooking it. He said it's absolutely rammed. So I'll be very, very surprised if they weren't doing some brisk trade at that location, your flagship store in Oxford Circus.
Yeah, no, exactly. I think they're doing very well. And like I said, even the last update, they said, as yet, we haven't been affected. Touch wood. And Richard, the CEO, said, I don't want to sound arrogant or anything, but we haven't been affected by it. I mean, we're not energy intensive, particularly. So, we don't create things that need lots of energy and stuff like that. So it's looking okay. But, who knows? But, it doesn't help that everyone's striking. That's getting on my nerves a bit, the strikes now.
Yeah, no, you're right.
How about this? I was thinking about this. Why don't the government do something like, NHS and something like that, a rolling, because people are now getting pay rises based on this year's inflation, which is, it's an outlier. It doesn't happen very often. So why not have just, a 1% over average 10-year inflation every year? And that way, it'll smooth out the spikes and troughs in a more sort of, because at the moment it's ridiculous what's going on. 50-year average, I think, for inflation in the UK is 5%. So it's over 50 years. So I don't know. So it drives me nuts. There must be some kind of formulaic way they can sort this out.
Yeah, well, I mean, I remember the winter of discontent back in '79, so that was a long time ago. A couple of other sort of like, we talked about a couple of other stocks, but we talk about sort of more early day type stocks, but in sort of healthcare and all things technology. And the sort of the rough rule for that is go best in class and to think long term. And Belluscura have talked about it. They do portable oxygen concentrators for sort of like respiratory conditions, things like COPD and long COVID and all that kind of stuff. They struck a international agreement, a distributor agreement in South Africa, which is a really, I mean, in itself, it may not be sort of like, massively, move the dial, but just figurative wise, again, it's a huge, step for them because they've come out the US and they're now expanding into Asia, into South Africa, and they will be into Europe. And this year, coming into 2023, that could really be an inflection point for them because they'll see a lot more of their units sold of the portable oxygen concentrators, and they'll start really sort of attacking that much larger total addressable market because it effectively outside the US is about half the world's sort of like just less than half the world's sort of market size. And then sort of addressing and moving into the other areas will double that. So again, they're really sort of like, continuing what they've done before, which is sort of like, commercializing that whole strategy. They've got a solid balance sheet, and we should see a real sort of like, massive difference in terms of, units sold and they can basically sell everything they can manufacture at the moment, but they'll start also getting their Chinese manufacturer on board as well, putting out some serious volume early next year, which again a little bit they can service outside the US and in the US as well. So all everything's sort of moving in the right direction there. But that is more earlier days. The real sort of like significant revenues will be in 2023.
Do you know what? You've got a cough there. I've got a cough. It's just going away. I've had it for like 2 or 3 weeks.
Could do with a portable oxygen concentrator.
Yeah, but do you know what? This is quite, and also we've all had it in the house. So my son, who's got a lung condition, we do regular cough swabs with him if he gets ill, and he had flu and RSV. He's being operated, and oddly, I talked today to Jeremy, and I don't own this company. Jeremy from CEO of Poolbeg Pharma.
Oh,
that's
yes,
very interesting because they basically. It had a collaboration with was it, I think, what they call it,
Open Orphan. It's H
well,
Vivo, isn't it?
Open Orphan. Yeah, it was a spin out from Open Orphan. But One Three Biotech company is an AI company. Now, what Poolbeg do? They got all human trial data from. They bring people in, they give them a bit of a disease, and they test them and see what's reacting.
Yeah, challenge trials, aren't they?
Challenge trials. Yeah, so they got all this data from all these people, and they've used AI, and they've actually come up with now. Drug targets to deal with RSV, which is what a lot of these coughs are going around at the moment. And of course, if you're healthy, it's okay. But if you're immunocompromised or you're old, it can take you down. So, and they're doing it. So they're developing up sort of preclinical or clinical trials, and then they'll partner with bigger companies that take this through clinical trials. I think that's very interesting because that's the first time when you're looking at companies thinking who's cutting edge, who's doing something new. That's the first time ever they've come up with targets for drugs through RSV through AI. I think it's very interesting because it cuts a lot of cost. Now, big pharma companies can do this, then so it's worth keeping an eye on that company. And the guys there, I know the guys behind it quite sharp, and Cahill and Jeremy there. But I quite like that, and they're on the podcast on a regular basis, and that's part of the reason why I started doing a podcast, to sort of get close to the CEOs and talk to them about it. So it's just very interesting. Keep an eye on Poolbeg because I think things happening in the next year or so.
Yeah, I mean, I did the last couple of weeks I organised this stock picking challenge for 2023, and actually Poolbeg Pharma came up quite a lot from really smart investors. So they think it could have a really big year next year, next couple of years. So yeah, I'm with you. And I've heard some institutional investors talking about it. That is, given they've got the access to that challenge trial data, that gives them a real USP. That, because frankly, people haven't got that type of level of, over such a long period, that depth and quality of information.
Yeah, and they obviously spun out from HV. It was Open Orphan, and HV do these challenge trials. I think they're the biggest challenge trial in the world now.
It is, yeah. Well, that's exactly.
So they got all this data. They can, and they obviously they need something like 1-3 Biotech to sort of.
They're really well,
huge amounts of data and bring up relevant points. But so that's very interesting.
They're really well positioned there.
Yeah, who's number one on that list? Is it Avacta, I think, isn't it?
Yeah, Avacta's number one. Yeah, well, there's a surprise. I mean, they've got a massive data point coming in probably in January, which is the releasing their phase 1 AVA 6000 data, and that should give people a much better sort of like view of how patients have responded in terms of the safety profile, which seems to be absolutely fine. They should also provide more information on the dosage and also on what they're going to do for the next level in terms of getting the most effective sort of treatment for the rest of that sort of like the phase 1B. But that could be a huge event. I don't think they're going to have efficacy data, but they might have something that gives something that implies that it's actually the chemo warhead is depositing over the actual solid tumor to be able to shrink it. Anyway, I'm getting ahead of myself. Everybody's really excited about this. There's a huge amounts of, sort of like potential upside. And regardless of that, it actually could be a massive difference to patients around the world that are dying of cancer and solid tumors that have got no other way of actually getting treatment. So this could be a real sort of game changer if it eventually sort of like comes off. But anyway, they're top of the list. I mean, another one it's hugely supportive. There's a lot of people know that story. That's what I love about investing in private investors. You learn so much. I mean, you can start off as an average guy, and you can actually learn about the intricacies of biopharma, and and it's amazing. Yeah. I mean, another one in that biopharma that again has got a brilliant data data bank is Oncimmune. And they're basically one of the world's leaders in autoimmune sort of like proteins and stuff, or auto antibody proteins. They've got one of the biggest libraries there, and they've really seen a huge uptick in new contracts. And they came out with some more sort of wins this week as well, and they've done it over the last 2 or 3 months. They're seeing that they're going to then increase their turnover for this financial year by about 75%. They're going to be EBITDA break even, cash flow break even, and they just raised another 2.1 million gross just to give them some top up finance to give them a bit of extra working capital so they can actually grow. And they wanted to do some more analytical biomarker stuff as well. So they're really well positioned. And then that's the ImmunoInsights part of the business, the service business that does the blood samples in Dortmund in Germany. They sell a lot of this service out into big pharma, out into the US. And then the other side of it is their products business, which is this early stage lung cancer test that again is profitable, and they're doing what they're supplying into the NHS and also out to the States with their distributor Biodizix, and they're actually looking to spin that. They may be looking to spin that one out, actually, a bit like doing HVivo as what they did with Poolbeg. So there's lots of moving parts there and potential value catalysts, and the shares have been knocked hard, really just on a sort of top up funding. The directors have piled in as well at this fundraise, so it all sort of like points that things are moving in the right direction there. Anyway, I'm hoping to speak to the CEO Adam Hill later today. So with a bit of luck, the video should be available for investors sometime tomorrow. But I think that one's another one. Do
you know what? There's so many companies, like I said, in microcaps. I'm not excluding microcaps. I do hold microcaps, and I think that's the kind of company. Like I said, well, once the money starts coming back in the market, I think we'll fly. They've got something unique. It's it appeals to big pharma companies. Like I said, they were 240 a share back in May last year, and now they're 56 pence a share. So I think those kind of companies like that will fly. And it's just everyone's bearish. Everyone's pulling money from the market. So that's a big worry.
Yeah, long duration assets have just been totally taken to the woodshed, haven't they? I mean, they're absolutely, particularly in immunodiagnostics, and they've got world-class, sort of like technology there that you can't replicate. I mean, you just physically can't. The barriers to entry are absolutely enormous. So I'm with you. I mean, another one which again has been knocked is Saietta. We've talked about this one in terms of
I'm watching that. I mean, because I think again, amongst the microcap space, that could be huge in the next few years. But
it was huge. I mean, the shares were over £2, and the last time I saw them were about 70p or something. I don't know what they are today, but they've been knocked. But just for investors, I mean, people may recall they started off as effectively, they started off as sort of like an axial flux electric motor manufacturer and developer with unique patented technology, but they've now moved into eDrive for all EVs and the power electronics associated with it, and they're concentrating on their huge opportunities, firstly out in the States with Comet to do large truck and trailer e-hubs for for wheels and stuff like that, and drive lines out in the States. That's with Comet. They're also there's some opportunities in marine, but their biggest, one of the biggest short-term which they announced a sort of contract win, is their joint venture in India to do sort of like light mobility scooters and three-wheelers and tuk-tuks and stuff like that. And they announced a big contract out there that their joint venture with Padmini, this is Saietta VNA, I think it's called, has signed it with a massive, OEM to make these sort of e-scooters out in India. And again, that could absolutely be huge. They've just got to now scale it up. That joint venture needs to build up the or install the factory and get that up operational and start producing. So the timeline really is first sales should be in about 12 months with a bit of luck in India and in America. And again, this is going to be another seminal year, really. We've talked about it for Belluscura, for Oncimmune, and it's going to be a similar sort of thing with Saietta. But these guys really are moving at sort of like, light speed. I mean, their business model since they IPO'd, the timescales have just been sort of like accelerated so fast, and the opportunity set is just enormous. And then to see your shares being totally bashed and hammered It's just like, well, it's like a kick in the teeth as much as anything. They've excelled in every department.
But part of me thinks, I've often thought about in these kind of markets, there are so many opportunities out there. It's too much to count. But if you just, bring it down to what companies have something special, something unique in IP.
Yeah.
And I've often thought about having a bit of a scattergun approach, put a little bit of money into each one, in about 10 companies, small micro caps that you think is very special. And then the one that starts to really move, then just double down on that a bit more, And the other ones, you haven't got a significant stake. If they go the wrong way, but still, high risk, quite risky in micro caps. So just ignore them. But I mean, these are the kind of things you need to hold on to for a couple of years, but not put too much in, just a tiny little bit maybe. And then when it starts to move and starts to gain traction, then start increasing your investment into it.
Yeah, I would say, another important leg to that is just think about microcaps in terms of their risk profile, okay?
Yeah.
And therefore your hit rate on microcaps is going to be less just by volatility than it is than your large caps. And therefore you want in your portfolio, you want probably more micro caps, i.e. you put a smaller position in and then wait for the upside than you prepared to put in for your larger caps, which would be a larger exposure. So I would say when it comes to your hit rate, make sure you build in that level of extra volatility. And so let's just say, for argument's sake, out of your large caps over a long period, over a 5-year period, you might make a 70, 80%, sort of hit rate. 7 or 8 out of 10 are going to generate you money. But in your micro caps, it might only be 3 or 4. But it doesn't mean over your portfolio of micro caps, it doesn't overall generate. It's just that you've got to be able to stomach that level of volatility and risk.
Yeah. I'm right at small amount. I mean, not exceeding 1% of your entire portfolio value. Just keeping it low and like I say, in this market, you don't know what's going to happen. But like I said, quite a few of those will do very well over the next 3 to 5 years when the market sort of comes alive again.
Yeah.
But sometimes I've seen companies, that you can look at 2 companies and one is seemingly superior and another one will catch the attention of investors and it'll just go nuts. So sometimes, it's hard to pinpoint the one that's going to do really well just on sentiment wise. But some of them, once, like I said, the way they are oversold now, they can be overbought like that massively as well. So they could do multiples of where they are. And we don't think it's going to happen because we're in a bearish sentiment, but it does happen. And sentiment can change very quickly, on a rally. You see it even in America. I see everyone's sort of bearish now on CNBC and all that stuff because the market's going down. It has a rally and all of a sudden that's the bottom. Everyone's really bullish again. Whoa, hang on a sec. There's still a bit of a downtrend. So the sentiment can change very quickly and money flow with it, So yeah. Anything else? Look at that.
No. As I say, I wish everybody a happy Christmas, and I know in your family, Justin, with the 47% cash weighting, you're going to have a very very nice. And
that's not going anywhere. I haven't told the wife that. It's staying in the account there. It's not going anywhere, even though she starts Christmas shopping in early November.
Don't overcook the turkey either.
I know. Exactly.
That's your own pal.
God, I'm glad you survived this webinar.
Yeah, sorry about that.
I'm not joking. It is. I don't know what's happened with COVID and stuff, and that's why I've sort of brought up Poolbeg. It's very appropriate because I don't know anyone I've talked to recently who hasn't got a cough or a cold or had one. So something's going on. It's really odd, but hopefully we'll all be healthier and the market-wise as well come next year. Like I said, I think we'll have probably a volatile Q1, but there's plenty of opportunities out there. That's the reason why I want cash. Because one of the best times ever to make money ever. It's like a 1 in 10 year opportunity coming up, and I think it's going to it'll be months away from it.
Yeah, just take your time and upgrade the quality of your portfolio. Don't get too overexposed and think long term. Those would be the key sort of takeaways I would suggest.
Do you know what? Whenever I've gone wrong on a stock, right, pretty much I've gone too fast, too quick, too fast. And like I said, I should have held back a little bit and scaled in over months rather than sort of, just, you get, when you do research for a company, it's new, you get really enthusiastic about it and think, it's going to be massive. And then you go into it and you think, there's a pull back and a drawdown, especially in a bear market, you can take your time. Like I said, most rallies are sold into a little bit. So,
are you out, by the way, are you out of eEnergy now?
No, in fact, I was going to mention eEnergy. I was going to say this actually because I didn't get into it in Stock Pick Challenge, but I wouldn't mind putting eEnergy in there. I've taken a bath on it, but the financing companies, they did unexpected fundraise, which the market will not like at all. And it was bonds, largely with directors anyway, and with warrants attached, which annoyed the market because didn't expect it. It took a massive wash, but then now they're like 11 million market cap. They're forecast to be, operationally profitable. EBITDA 5 million this year, 30 million turnover. They're 11 million market cap. They're in quite a hot area. Energy prices are still expensive for companies, and so I think if anything, from where we are right now, I think it could do very well in the next year. So put me down for that, because just
we've closed the doors, we've closed the voting.
Okay.
So sorry, I can't even do it for you, mate. Sorry.
That's an unofficial last entry been denied. Okay, that's fine.
You'll have to monitor that one yourself. All right. Happy Christmas,
Cheers.
all.
I will. Cheers, man. Happy Christmas.